Hi guys, welcome to my YouTube channel.
Good day everyone. So today I'm going to discuss you about specialized accounting services. So what is specialized accounting services? Specialized accounting services, the field of accounting has a very wide coverage. This is because there are several types of the businesses operating in the business community. There are several interested users of financial statements, and there are several regulatory bodies of the government that require accounting reports. So, the following are the various fields of specialization in the accounting profession. Tax accounting. Tax accounting is a structure of accounting methods focused on taxes rather than the appearance of public financial statements. Tax accounting is governed by the International Revenue Code, which dictates the specific rules that companies and individuals must follow when preparing their tax returns. So I have here key takeaways of tax accounting. Tax accounting is a subsector of accounting that deals with the preparation of tax returns and tax payments. Tax accounting is used by individuals, businesses, operations, and other entities. Tax accounting for individual focuses on income, qualifying deductions, donations, and any investment gains or losses. For a business, tax accounting is more complex, with greater scrutiny regarding how funds are spent and what is or isn't taxable. Tax accounting explained. Tax accounting is the means of accounting for tax purposes. It implies to everyone, individuals, businesses, corporations, and other entities. Even those who are exempt from paying taxes must participate in tax accounting. The purpose of tax accounting is to be able to track funds in as well as funds going out associated with individuals and entities. So, tax principles versus GAAP or GAAP. In the United States, there are two sets of principles that are used when it comes to accounting, which it should be noted are different and should not be confused. The first is tax accounting principles, and the second is financial accounting, or generally accepted accounting principles, GAAP. Under GAAP, companies must follow a common standards and procedures when they compile their financial statements by accounting for any and all financial transactions. Balance sheet items can be accounted for differently when preparing financial statements and tax payable. For example, companies can prepare their financial statements implementing the first in the first out FIFO method. To record their inventory for financial purposes, yet they can implement the last in the first out LIFO approach for tax purposes. The latter procedure reduces the current year's taxes payable. While accounting encompasses all financial transactions to some degree, tax accounting focuses solely on those transactions that affect an entity's tax burden and how those items relate to the proper tax calculation and tax document preparation. Tax accounting is regulated by the International Revenue or IRS to ensure that all associated tax laws are handled by tax accounting professionals and individuals taxpayers. The International Revenue Services also requires the use of specific documents and forms to properly submit tax information as required by law. So the importance of tax accounting is hiring a professional tax accountant is optional for an individual, but often necessary for a corporation as business taxes are more complicated than personal taxes. Tax accounting for an individual. For an individual taxpayer, tax accounting focuses solely on items such as income, qualifying deduction, investment gains or losses, and other transactions that affect the individual's tax burden. This limits the amount of information that is necessary for an individual to manage an annual tax return. And while tax accountant can be used by individual, it is not a legal requirement. Meanwhile, general accounting would involve the tracking of all funds coming in and out of the person's possession regardless of the purpose, including personal expenses that have no tax implication. Tax accounting for a business. From a business perspective, more information must be analyzed as a part of the tax accounting process. While the company's earnings or incoming funds must be tracked just as they are for the individual, there is an additional level of complexity regarding any outgoing funds directed towards certain business or obligation. This can be include funds directed toward specific businesses, expenses, as well as funds directed toward shareholders. While it is also not required that a business use a tax accountant for perform these duties, it is fairly common in the larger organization due to the complexity of the records involved. So the fact of accounting, even legally tax-exempt organizations use tax accounting as they are required to file annual returns. Tax accounting for tax-exempt organization. Even in instances where an organization is tax-exempt, tax accounting is necessary. This is due to the fact that the most organizations must file annual returns, so they must provide information regarding any incoming funds such as grants or donations, as well as how the funds are used during the organization operation. So this helps ensure that the organization adheres to all laws and regulations governing the proper operation of a tax-exempt entity. So, cost accounting. Cost accounting is the reporting and analysis of a company's cost structure. Cost accounting is a process of assigning cost to cost objects that typically include a company products, services, and any other activities that involve the company. Cost accounting is helpful because it can identify where a company is spending its money, how much it earns, and where money is being lost. Cost accounting aims to report, analyze, and leads to the improvement of international cost control and efficiency. In short, cost accounting is a system of operational analysis for management. So I have here a key takeaways of cost accounting. Cost accounting is the reporting and analysis of company cost structure. Cost accounting involves assigning cost to cost objects that include company products, services, and business activities. So cost accounting is helpful because it can identify where a company is spending its money, how much it earns, and where money is being lost. So for understanding cost accounting, even though cost accounting is commonly referred to as a costing method, the scope of cost accounting is far broader than mere cost. Cost accounting has elements of traditional bookkeeping, system development, and creating measurable information and input analysis. Types of cost in a cost accounting. Although there are many types of costs that businesses can incur depending on their industry, below are a few of the most common costs involved in cost accounting. So, direct cost. A direct cost is a cost that directly tied to the production of a product and typically includes direct materials, labor and distribution costs, inventory, raw materials, and employee wages for factory workers are all examples of direct costs. Indirect cost. Indirect costs can be directly tied to the production of a company and might include electricity for a factory. Variable costs. Costs that increase or decrease with production volumes and tend to be classified as variable costs. A company that produces cars might have the steel involved in a production as a variable cost. Fixed costs. Fixed costs are the costs that exist to keep the company running and don't fluctuate with sales and production volumes. The lease on a factory building or equipment would be classified as fixed costs. Operating costs. Operating costs are the costs to run the day-to-day operation of the company. However, operating costs or operating expenses are not usually traced to the product being manufactured and can be fixed or variable. Cost accounting versus financial accounting. Financial accounting and cost accounting systems can be differentiated based on their respective target audiences. Financial accounting is designed to help those who don't have access inside the business information, such as shareholders, lenders, and regulators. For example, retail investors and who analyze financial statements benefits from a company's financial accounting. Alternatively, cost accounting is meant for those who are inside the organization and are responsible for making critical decisions. There is no legal requirement for cost accounting, unlike financial accounting for publicly traded firms. Cost accounting is distinct and separate from the general financial accounting, which is regulated by the General Accepted Accounting Principle or GAAP and is critical for creating financial statements. Cost accounting is helpful because it allows executive management of companies to understand how to use its resources more effectively by tracking and measuring them and study their effects. Objectives of cost accounting. Often, the simplest and most important objective of cost accounting is to determine selling prices. A business that sells sandwiches, for example, would you need to track the cost of bread, lettuce, sandwich meats, mustard, and other ingredients. Otherwise, it would be difficult to calculate how much to charge for a sandwich. Cost accounting can help with internal costs, such as transfer prices for companies that transfer goods and services between divisions and subsidiaries. For example, a parent company overseas might be the supplier for its U.S. subsidiary, meaning the U.S. company would be charged by the parent for any purchases of materials. Cost accounting can contribute to the preparation of the required financial statements and the area otherwise reserved for financial accounting. The prices and information developed and studied through cost accounting are likely to make it easier to gather information for financial accounting purposes. For example, raw material costs and inventory prices are shared between both accounting methods. Entrepreneur and business managers rely on actionable information before making allocation decisions. Cost accounting buoys decision making because it can be tailored to the specific needs of each separate firm. This is different than financial accounting, which is GAAP and International Financial Reporting Standards or IFRS regulate method and presentation.